So to me personally, I follow my game plan, which you see me do every day. And as a trend trader or securing the profits quicker, when the market's mixed, just know that more times than not, you're not going to get a nice extended move down like this. So knowing that, you should be quicker to put a trail stop or a stop loss in place, if that makes sense. But that's just my opinion. You follow me?
Mm-hmm. Yeah, I do.
So next time it's mixed, what do you want to do?
Probably sit on the sideline.
I mean, you could
Because
do
I'm
that.
just not good.
You could sit on the sidelines, or you could also trade with less capital. Or I mean, understanding that you can still trade, but you just got to protect yourself a lot quicker. So if you're uncomfortable doing that, then I would sit on the sidelines.
Yeah.
Hopefully that helps you.
Yeah, it does.
Awesome. Can you type the symbols you use to determine market sentiment? Yeah, so I follow these right up here. I follow the futures markets, the /YM, Frankie, if you're on Thinkorswim, the /NQ, which is for Thinkorswim, /ES, and /RTY. Those are the futures symbols of the Dow Jones, the US 30, of the NASDAQ, which is the NQ, the S&P 500, which is the ES, and the Russell 2000, which is the RTY. That's what I look at. I look at the future symbol. Some people look at the market itself, and that's totally fine. I like the futures.
When you're looking at those, Brandon, are you viewing those in POS as charts, or are you looking at them in trading view as a chart?
I don't look at the charts for the future sentiment. I look at my numbers here. I understand when I come into the trading day, like right now, if it's 9:30, I'll know that the Dow Jones, which is /YM, if it's at +30, and then 10 minutes later it's at +45 or +50, I know that we're starting to increase, and we're probably going to start trending sooner than later. So I know where the baseline is when I come into the markets, but to me, it like you can't look at 4 charts to determine what you're going to trade off one other chart. I mean, for me, I try to simplify it, so that's why I keep my future symbols up in the upper left-hand corner, and I always look at it, and I also look at the VIX as well. So if we open up and the VIX is at 2165 and it's going up higher, I know that the probability is the market's dropping if VIX is increasing. If VIX is decreasing or falling, then we know that the market is more than likely increasing. You follow me?
Yeah, I guess I'm having difficulty getting your screen up, but I got you. I can watch the replay on it. I will anyway.
Got you.
Yeah, the only reason I asked is because I think at one time, that's the way Black was doing it. He was showing it, I believe, in his watching Tesla as it moved, and then looking at the, similar to what you're saying, but he had him off to the side in his watch list so he could.
Yeah, and that's what I have. I have mine in a watch list in the upper left-hand corner. So, like, if I'm taking a trade,
your Thinkorswim.
Yeah, in my Thinkorswim. So if I'm taking a trade,
okay, that's what I was asking. Where do you have it? Okay.
Yeah, in Thinkorswim. Yep, it's just a watch list.
Gotcha.
Anybody else have any other questions?
The one question I have is,
Go ahead.
Whether it's a buy, call or put.
Repeat yourself because you went in and out.
Where it shows me the dollar value, what it costs me, plus 65 cents. You ever look at that screen?
Just wait. What are you asking? Just wait. What are you asking?
When I purchase a call or a put, there's a screen that'll come up where I click it to go forward, but it will show me the cost of the purchase plus I believe the commission fee is 65 cents.
Yeah.
Because it'll say cost plus
Yeah.
65 cents. What's my total? But then when I submit it, I know that there's some fluctuality in there as far as or some fluctuation in there because I typically come up either at zero value or negative value. Is there any way to know in your mind how to eliminate purchasing that at a negative value, or is that just a given?
So that's a good question. So
that's a good question.
I hear me echoing, so I'm gonna mute you.
hear me.
So when you take a trade, when I no matter what you trade, we'll just say from simplicity standpoints that you buy one option, and you'll pay 65 cents in and 65 cents out, which basically corresponds to $1. Anytime that you take a trade on the stock option side, you're negative right away because there's a spread. So when you take the position, especially if you market order in, you're going to get filled on the ask, and it's going to show you what your contract's worth on the mid price. But when you sell out, it's going to sell you out on the bid price. So like depending on if you have a spread or how large a spread is, that really determines how much you're down. So like every day I trade SPX, I'm always down 30, 20, 10, 20, 30, $40 as soon as I take the trade, because when you go to let me pull this up. When you take a trade on SPX, and you see that where's that SPX, and when you day trade it, right, like we all do, and you look at tomorrow's expiration, it's going to do something like this. Look at the spread, 1,600, which is 1,600, and 1,530. So there's about a $60 or $70 spread difference. So when you take this trade, you're automatically down, with the mid price being 50 or 60, like 1550 or 1560. One contract, you're automatically down $40. So there's really nothing that you could do, and that's the downfall with trading because they do have a spread. So you need some kind of movement in your favor to be net profitable. Now you also got to think about, if we go to the SPY, because a lot more people trade SPY probably. Same thing on SPY. You're going to take this position, and since it's fluctuating, it's going up and down so fast that you might get filled at $1.34, but if it's worth $1.31 or 32, you're going to be down about $2. But realistically, you're down $3 because when you go to buy this, and say we go to one contract, and we go to market, and you press confirm and send, it'll show you right here that you're paying $130 plus 65 cents. So now you're paying $130.66. Well, if you come down here to the bid, which is $129, it'll show that you're down -$1, -$2 right out the gate. So essentially, if you take this trade and SPY's at 381.40, SPY probably has to get to 381.44 or 45 for you to be net profitable in this trade in order to cover the spread and your commissions. So how I look at it is I look at it like, if I'm getting filled at $1.31, I know that I need my break even is $1.32, because for every one contract in and out, it's basically $1, and there's nothing that you can do to bypass that, because that's how the brokers make their money. Does that make sense?
Yeah, it does. In fact, it comes to another question where I was thinking about, you know, you're so fast in being able to know, like for instance, when you're calling SPY in the morning and you call your dollar amounts to say, I'm up $1.26. What helps you to calculate that so fast? Is that just experience?
Well, there's nothing, because I see. I hear the echo again, so I'm muting you. To me, it's nothing because I see what the actual dollar amount of that position is in my trade. So like if I take the trade and it's moving in my favor, remember, if I'm going in to buy this contract at $1.31 and I press confirm and I press send and I'm in the trade, I know that I got filled for $1.31. I'm immediately going in here to close this trade out, and I'm putting a trail stop in of 5 cents. And in my head, I know that I paid $1.31. So when I see like the bid or the ask or the specific contract itself go up to $1.45, I know that I'm up 15 cents. So if I put a 5 cent trail in, then I know that I'm going to get stopped out at $1.40. So in my head, it's just experience because I've been doing it for 6 years, but I know what I got filled for because the second you buy the trade, it shows you on your screen what you paid for it. You follow me? So if you're looking at the chain or you're looking at your position move and you set that trail stop, when you go to close your order out, it'll show you it'll show you the option itself, what it's worth, and you just do simple math in your head. So it's like if you bought it for 130 and it's worth 160, you know that you're up 30 cents or $30 on that trade, and I'll initiate my trail stop. You follow me?
Yeah, I do. I get you. I
So
get you.
that's really all I'm doing. But the thing is like when you make $10 on SPY or 10 cents on SPY, you're probably making like 75 cents or $1 on SPX. But you got to remember, if you're trading SPY right here at $1.31, you're risking 131 one contract, but I'm risking $1,300. So we're still making a similar ROI. I'm just risking 10 times the amount you are. So if you're up 20 cents, that means I'm up $2. You follow me?
Yeah, I understand about SPX. You know, you correlated the difference between the two, and that there's a bit of a benefit in trading SPX.
Yeah, there sure is. You get taxed at a different rate trading SPX than you do SPY. So to me, if once you start making a lot more money and your account grows larger, instead of taking 10, 20, 30 contracts in SPY, you could take 1, 2, or 3 contracts on SPX, and the difference of spending $30 in commissions or $3, I mean, that's $27 extra. That's a lunch. You know what I'm saying?
Yeah, I do. I guess what I need to do going forward too is also count in that additional. I wasn't counting in 65 cents in and 65 cents out. I was just doing 65 cents and calculating what I needed my return on investment to be.
Yeah, I mean, instead of making it more difficult, all you really got to think about is like, look,
the book.
whatever I pay for it, I need 1 cent higher, and that's essentially me at a break even. You follow me?
I got you. Okay. Then when you get ready to close out, again, on that same screen where you see your dollar amount, there is something that's written on that screen or displayed on that screen called break even. What is that?
So that's,
you know what I'm referring to?
Yeah, I know what you're referring to. So basically, that's where you need the share price to be if you're going to hold that contract until it expires. To me, it's irrelevant because I'm in and out way quicker. You know what I mean?
Okay, if you hold it to that, in order to break even, that's where you're looking for that end result to even just
so like
away.
if you buy this, and this is just theoretical, so this isn't like factual because I don't have the numbers right here. But let's just say you bought this contract for $131. If and the share price is $381.40. Well, if this trades sideways all day long until the end of the day and you don't close this position out, this contract's going to be worth $0. You follow me? So it might say that your break-even price is going to be $383, which is $2 higher than where it's at right now, because at the end of the day, your contract, if it moves $2 higher, at the end of the day, when it expires, the contracts will then be 2 strikes in the money, which then this 249 will probably be worth 131, and that's why it says break even. But we don't have to worry about that as day traders because we're not holding it until it expires, nor do we have to hold the swing trade until it expires. Does that make sense?
Yeah, definitely. I was just wondering if that was a number I should pay attention to as far
Yeah,
as.
nah, if you do that and you hold your trades until that all the time, I feel like you're going to lose a lot more than you're going to win, especially if you're taking quick scalps. Because remember, I want to be in and out of the market as quickly as possible, and that's why you always hear me say I'm going risk free.